Hi, it's Saturday, July 30th, 2016. Monaco 64 here, home of alternative economics and contrarian views. I'd like to talk about stagflation today, especially with what we saw yesterday in terms of data. We saw US GDP data for the second quarter came out, and it was expected at 2.6%. At least that's what all the Wall Street economists were expecting, and it came out at 1.2. But worse than that, first quarter GDP was revised to zero point 0.8 from around 1.1. And the reason why I bring that up with stagflation is because the definition of stagflation is a stagnant economy with a high cost of living or high inflation. And the reason why I use cost of living is because nowadays we're told that inflation is CPI or PCE. We're told by Yellen and the Fed and the ECB that inflation is very low, but I don't agree with that. And I made a video back on April 28th, and it will be up here just now on the card about stagflation and how stagflation is back. And one of the points I made is that the US government, they overestimate GDP growth and they underestimate the cost of living, the rising cost of living. And one of the reasons for that is that they don't include rental prices, how much people pay for renting dwellings in the States in their measures of prices, or what they call inflation. I don't like the term inflation to define rising prices, because inflation is actually the rise in the money supply, not the rise in prices. The rise in prices is a consequence of the rise in the money supply. And it's like, it's kind of proven me correct, especially with yesterday's number of GDP. The fact that they've been revising data, past data. They overestimated to make it look like the economy is doing better, but they actually have to come back and revise it way down. So, and the other point I like to make is that Zero Hedge published an article yesterday, and it was an article on Greenspan, and Alan Greenspan basically was on an interview with Bloomberg Television, and he agrees with Monaco 64, with Mario. He says stagflation is the biggest threat, and he thinks it could happen quite soon in the US. And he also points out, like I do, that in the end of the day, inflation is a monetary problem. It's too much money that leads to higher prices. He does mention that the rise in wages without rise in productivity also create inflation. I don't agree too much with that, but he does agree with me that money supply, the growth of money, is what creates rising prices, and that is inflation. And he notes that money supply growth has been picking up in the US. And the other point I like to make is that I made a video recently about whether we're very close to the end of the bull market in bonds in the US. And what that means, are we very near the end of dropping interest rates and low yields? And Alan Greenspan seems to agree with Monaco 64 there as well. And he says that if human nature is human nature and hasn't changed, which he says he would bet on, human nature hasn't changed since Roman times, for example, interest rates where we are now, 1 or 2%, are not sustainable. And he points out as well that the Bank of England, they've got data going back to 1694. And since then, the rule of thumb for interest rates is any level between 5 and 10%. So, and again, he says human nature hasn't changed. We will go back to those rates, and he thinks we're very close to that. So interesting to see that Alan Greenspan agrees with what I'm saying. I'm sure he wouldn't be saying these things if he was still a chairman of the Federal Reserve. Now he's free to come out and say, what's true, even though he doesn't point out to the fact that the reason why there's a bond bubble is because the Fed, is encouraging it with QE, zero interest rates, forward guidance. He points out, though, that if people look at price earnings ratio of stocks, why don't they look at price earning ratio for interest rates and bonds? He says it's highly priced, bond prices, and I agree with him. So listen to my previous videos that I've made, and it's all up on the cards there. On the just click on the I, and you'll find all the relevant videos I made about this. So yeah, that was a shock yesterday. Supposedly, to the Wall Street, it was a shock, but it wasn't to me. And Zero Hedge says here, with Wall Street expecting the U.S. economy to grow 2.6% in the second quarter, there were many shocked faces moments ago when the Census Bureau reported not only did the U.S. economy grow at a paltry 1.2% in the quarter, but Q1 GDP was slashed from an already poor 1.1 to 0.8. So there you have it. Let's have a look here. There's more revisions. Just as bad, strong historical GDP reports such as the 3.9% alleged growth in Q2 2015, which served as the springboard for the Fed's rate hike rhetoric in mid-2015, was slashed to 2.6%. So there you have it. Monaco 64 was right about the government and the Fed. They lie to you, and then they come out and say, oh, it was just a revision. They're overestimating growth, underestimating the rising cost of living. For now, bond markets yields are still very low, treasury yields, but that's artificial. How long they're going to be able to keep that, the powers that be, I don't know. And that's why gold and silver are going to go up, unless, they can manipulate that as well, because gold and silver they protect, the purchasing power of people's wealth. But if you put your money in treasuries, you're doomed, especially longer term treasuries, 10 or 30-year treasuries, 30-year bonds, because the rising cost of living is a lot higher than they tell you, and you're only getting 1.4% 10-year, and I don't know, about 2% 30-year. That's going to eat away at your purchasing power. So thanks, Mr. Greenspan, or Dr. Greenspan, whatever your title is, for agreeing with Monaco 64 that stagflation is a problem, and it's going to be with us quite soon. Whether the bond market will react to that, we'll have to see. I think it will. So if you enjoyed my analysis and my videos, please share far and wide. We need to get some more subscribers. We're almost up to 2,000 subscribers, and I'd like to get as many people as involved, in the comments below, in the discussions, so that it can help me, with all the, coming up with new subjects and new, analysis for all of the viewers. And thanks for watching. So like, share, and subscribe. Subscribe if you haven't yet to my channel. Take care. Bye.